someone just starting and a limited partner, this is a really interesting environment for them to get started. And it's one thing to get started in 2012 and then never see a deal go bad. But if you've gotten started in the last 12, 24 months, I remember, right, capital calls used to be a sin. And now it's all capital calls. Okay, I had three last year. Like it's just it's almost okay. Cardinal sin now is commonplace. So this is a really interesting environment for a newer limited partner. Like, what would be your best piece of advice? And I know I'm not sure if you still do LP deals or you just do your own deals at this point. But if you were talking to a newer limited partner, what kind of advice? Let's say your son wants to, do some of these investments. Like, what would you tell him to look for in today's environment?
Geez, we could talk a couple of hours on that. Number one, you've got to vet the deal and you got to vet the sponsor. But truthfully, at the end of the day, the success of the investment is going to more rely on the sponsor than the deal. Any bad sponsor can take an amazing deal and run it into the ground, but a great sponsor can take an okay deal and turn it and either bring it or land it successfully or make it really good. So the key is really to vet the sponsor. And so what does that mean? Well, it's get referrals and not necessarily referrals that the sponsor hands you. Go find your own referrals, right? So if you're investing with, a sponsor, go post in BiggerPockets forums and post on Facebook. Say, hey, does anybody know this guy? Has anybody invested with this guy? And find your own referrals. Second of all, in terms of the deals, look into what kind of assumptions they're making. Are the assumptions they're making for rent growth and insurance, are they more aggressive than what the market really is? I saw a deal a couple of weeks ago. They were projecting 7% rent growth for the next 5 years. I'm like, that's not very likely to happen. So look into the assumptions. Do they seem realistic? And really, I think one of the biggest mistakes LPs make is focusing on the projected return on the email blast or the investment summary or whatever. Generally speaking, the higher it is, either the more aggressive the assumptions or the higher the risk. If I see a multifamily syndication and they're talking about 18 plus IRR, that to me is a huge red flag. It either means it's highly leveraged, they've got really aggressive assumptions baked in, maybe a really low exit cap rate, so the whole deal works just because they're assuming they can sell the property at a much higher price down the road. So keep in mind, there's the whole phrase about if it looks too good to be true, it probably is. That's generally the case, especially now. If I see anything over 15% IRR, I'm starting to get concerned. Also, another one is if you see preferred returns that are greater than what the property produces, then that means that operator is raising extra money and then giving it back to you, calling it a distribution when it's actually just basically getting money from other investors to give it to existing investors, right?